the routine.
Okay, we're live.
Thank you.
Okay, thank you, everybody. The meeting of the Tax Review Commission is called to order on September 15th at 12:01. First order of business is public testimony. Is there any?
We have not received any.
Okay. Unless somebody from the audience wants to identify themselves, let's move on to minutes of August 18th. Are there any additions or corrections? Hearing none, can I have a motion to approve the minutes?
Move to approve the minutes.
Thank you, Winston. Can I have a second?
Second.
Alton, all in favor say aye.
Aye.
Aye. Any opposed? Motion carries. Okay, so the next item, Bybars is going to present his report on what past tax review commissions and their consultants have recommended that are related to the priorities that we've identified. And I want to note that Murray is with us. Hi, Murray.
Okay, good afternoon, everyone. I'm happy to share the summary of the past recommendations by past TRCs. The idea was to kind of take a look back and see the work that has been done in terms of the 8 issues that the current commission has identified for possible investigation and potential recommendations. In doing so, I've earlier this morning, I sent you the draft report, which includes the relevant policy changes and some discussion and background information that might be pertinent to some of these issues. I've grouped them under the topics that have been identified, and I have brief remarks about each one of them. And I want to first start with the carbon tax, greenhouse gas impact fee issue. This was the recommendation of the 2015 and 17 TRC, and they basically asked for an in-depth study to study whether Hawaii should have a carbon tax, which would be the first in the nation. But not just that, study the effects on other state goals and what to do with the revenue as well. So in effect, I mean, there were already concerns that this would be a regressive tax since lower income households spend a greater percentage of their income on energy. And there were also questions whether there were no other states that have instituted this, so there would not be any lessons learned to look into, and it could potentially be politically a hard sell. Regardless, there was a Hawaii carbon pricing study by UHERO, the same team that TRC now tasked with a follow-up report. So the report was published this year in April, and in terms of legislation, I mean, obviously nothing has passed, but some proposals have been coming up in 19, 20, and 21 legislatures. So far, they have not advanced, but one example is the Senate Bill 3150, where they did propose kind of revamping the so-called barrel tax, which is an additional tax on several fuels, environmental response, energy, and food security tax. And the monies from this go to special funds for environmental purposes. So we do have some form of an environmental tax currently. So this proposal kind of tweaks and works on this ERT, or the barrel tax, and I'll be able to present some work on this and some potential revenue estimates. But I think we have other items on the agenda for next week already. So potentially, maybe in the coming month, I'd be happy to present about this. And hopefully the UHERO will be also presenting some updated work on the policy aspects of it. The second issue that was identified by TRC is the visitor impact fees. There were no recommendations about this in the past. As you know, last month we had the Hawaii Green Fee presentation by Dr. Jack Kittinger and his team. But there was one actually visitor green fee measure that was under consideration in this year's legislature. And I'm going to be talking about that next week and talk about some potential pros and cons of the approach. So that way we kind of have some background into some of the discussion that is taking place at the legislature. So they propose basically a surcharge of $40 per guest of a transit accommodation. There are some technical details that I would like to get into next time, next week. The issue of standard deductions and personal exemptions, this was already discussed by Council Member Lloyd, and I made a very brief presentation about this. And the first one, I think this is an earlier recommendation, but they wanted to double the standard deduction for taxpayers over age 65. This is taken care of through personal exemptions, so it's not standard deductions. So standard deductions are based on filing status, not age. So this was not adopted. But the issue, as we have discussed before, is that since the standard deduction amounts are fixed by statute and changing infrequently, every single tax review commission has recommended to increase the standard deduction. As you can see, after each, the intervals with which this takes place, initially, once they are raised, they keep up with inflation, the standard deduction amounts, but over time, they get eroded by inflation. So by the time the next tax review commission comes around, they recommend, okay, it's time to increase it again. So one of the recommendations was, and this has been voiced by the last 2015 and 17 tax review commission, was to index it to inflation. So next week, I'm going to be presenting some of the revenue estimates that we have done, and more importantly, do an analysis about the impact of such changes, not just the revenue cost, but more statistical analysis and the distribution over different sections of the by income and other measures in the population. So we'll be able to go more into detail next week. The personal exemptions, that has been increased in the last almost 40 years just once in 2013, and it clearly did get eroded by inflation over the years. However, as I had also mentioned last time, at the federal level, the personal exemptions have been completely abolished by the Tax Cuts and Jobs Act under the Trump administration in 17. So it is the other issue that we were going to be looking at. What happens if we follow the federal rates of dramatically increasing the standard deduction amounts, but removing the personal exemptions, except the ones that are for age and disability. So the other thing that the obviously 2015-17 Tax Review Commission recommended was, of course, this does come with a cost, right? Millions of dollars. And to balance and to keep it revenue neutral, they also recommended altering the tax rates and brackets to make it revenue neutral. So, you know, that is another issue to be discussed, obviously. Tax system compliance and enforcement. This was presented by my council member. I don't want to misspell Sale. Hiroshima,
Sale.
yeah,
Yep.
Mr. Hiroshima. Sorry, and it is one of those issues that has come up in previous tax review commissions. Obviously, the very basics in general is that The compliance initiatives are important because they would increase voluntary compliance, but also vast majority of Hawaii taxpayers do pay their taxes in full and on time. So it kind of imbues greater confidence in the system by those taxpayers as well. So the one relevant and important legislation was in 2009, the Cash Economy Enforcement Act, which has led to the creation of a special enforcement section. So their funding is slightly different, and they do operate under the department's compliance division, and they do include civil investigators and support staff. And there's a regular reporting annually to the legislature about the resources that are allocated to this and the revenues raised as a result of the act. I don't have much else to say. I think Sale's presentation was quite comprehensive. So moving to the next one, tax policy on real property and wealth. Beth is going to be making a presentation about property taxes. As we know, real property taxes are precluded from state. I mean, state is precluded from taxing real property. It's only done by the counties. So this issue has come up, and it's usually seen as the most practical way to tax wealth. Dr. Colby made a presentation about property taxes earlier this year, so we can refer to that. But in terms of what has been recommended in the past and what were some of the relevant legislation, the issue, the so-called HARPTA, which is Hawaii Real Property Tax Act, this is the withholding that is for when non-resident persons sell property here in Hawaii. A certain amount is withheld, and then they have to, once they file their personal income taxes, which they would be liable to pay capital gains tax on those proceeds. So that way we kind of ensure that those taxes will be filed. It would be very difficult to go after the non-filers. However, at the time of the 2015-17 TRC, that rate was at 5%. So the concern was that the long-term capital gains is 7.25%, plus a lot of these, I mean, it is possible that some of these non-resident sellers may have neglected to pay their transit accommodations tax or general excise tax on the rental income. And the HARPTA withholding of 5% would not be sufficient. So the recommendation was to increase it to 9%. And what has happened is initially it was 9%, then was reduced to 5% in 91. So this has been taken into consideration, and in 2018, the legislature has increased it from 5 to 7.25%. So this does take into account the fact that it would definitely increase compliance, and people would be more eligible would be more interested in filing to get a refund, because the difference is the 7.25% is assessed on the sale price. So typically that will be more than the actual tax liability of a person, where you do take out the costs and other closing costs and whatnot, and that the capital gains tax would take into account some of the costs. And so that way, in order to get their refund, they would have to file taxes. So the TRP estimate was that it would bring 8 million in fiscal year 2019 and 2.6 million thereafter. The other wealth tax issue is the estate tax. Under Bush administration in 2001, they repealed the federal credit for state death taxes, as it was called. What this did was there was a federal exemption that was a federal credit for the state level estate taxes. So all the states imposed estate taxes up to the amount of the federal credit. So it was basically transferring the money that the federal government could be collecting, and was a transfer directly, the so-called pure pickup to the states. But once the federal credit was removed, obviously the states could no longer impose estate taxes without creating extra burden, tax burden for the estates and their heirs. So the 2001 Act also increased the exemption amounts and also reduced the tax rates that fall under federal estate tax. So the recommendation of the TRC at the time in 2001 to 3 was that Hawaii should continue to utilize the pick-up tax as it existed up until 2001, once it was removed at the federal level, and also but conform with the federal, because there are several details of the provisions that were part of the federal law that they recommended conforming to. So Hawaii did conform in 2020 and 2021 to the form of the federal law, with the exception of the excludable amount remaining at 5.49 million, which was the number set in 2017 under the Obama administration. And then that has been obviously in the Trump administration in Tax Cuts and Jobs Act. They again doubled this excludable base, and but Hawaii kept the 5.49 million, which creates a gap between when an estate becomes taxable. But the one key thing is that none of the TRCs actually recommended to increase the estate tax. They just wanted to keep the status quo. We did have one bill, though, in Act 3 of SLH 2019, that the top rate of 20% was imposed on the for estates exceeding 10 million. So there was a slight increase that was estimated to bring about $2 million. The one thing about property taxes, so since the state cannot tax properties, the PFC report in the 2015-17, they looked into a policy measure that would eliminate the itemized deduction for property taxes paid as a way for the state to claim some aspect, and then maybe earmark this for things like education, or boosting the education fund. This was not recommended, though, by the commission itself. So moving on to tax credits and exemptions. So I just want to give a little bit of background. Winston Wong is going to be making a presentation. I've seen the memo. It's really well done. I just want to point out a few additional salient factors and leave some of the other details to him, so that we don't overlap. But the idea of the tax credits is that they're provided to individuals and also businesses and even on public utilities, and they reduce the tax liability dollar for dollar. So it's very valuable that way, in the sense the other like the standard deduction, itemized deduction, what they reduce is the taxable income, which then taxes are applied on, whereas the tax credits are directly subtracted from the tax liability. So in that regard, they are more valuable. They can be refundable or non-refundable. What it means is that non-refundable tax credits are up to only the taxpayer's liability, and the refundable one is that even if a taxpayer doesn't have any liability or might have negative liability, thanks to the refundable credit, would be effectively a subsidy. For instance, the film credit that we have, a lot of the companies are based in the continent, and they do not have any significant tax liabilities here in the state of Hawaii. So this is basically a subsidy to them. Similarly, some low-income households might be receiving food excise tax credit, so they would have negative tax liabilities, or would be receiving a check rather than having a tax liabilities to the state of Hawaii. Now, the main issue is, so why the past TRCs recommended minimizing or eliminating these tax exemptions and credits in general, is that, so when we reduce and give these exemptions, it means we are taxing a smaller share of what can be taxed out there, the so-called tax base. So once you shrink that tax base, so the more exemptions you provide, it means that if you want to still run the government and have the same amount of revenue to reach the policy goals, you would have to increase the tax rates on everybody else. And in general, there was some presentation about what is efficient. So every taxation has an inefficiency built into it. It does create welfare losses. So the higher the tax, the more the efficiency losses. So it's not ideal to increase taxes on the remaining taxpayers, and it also creates this potential favoritism and can be catering to special interests and hence be less equitable. So it would be violating potentially two of the main principles of equity and efficiency of taxation. So that's been the main reason why the past TRCs have indicated potentially minimizing or if not eliminating, minimizing them and putting them under scrutiny. So one way is that, okay, if you're not eliminating them, at least have a sunset date. So that was one of the recommendations in 2005 to 7 TRC. So that would trigger a review, and then the tax credit would be looked into, and should we continue this or not continue it? And then they can be reviewed to see if they're meeting the goals of the state. Now, some tax credits have been enacted with sunset dates, and some did actually get repealed. And some of them did actually get replaced with alternatives. And for the expired tax credits, some of them have been expired as early as 2003. To this date, they're still being claimed, because what has happened is that the taxpayers can carry over these tax credits to subsequent years indefinitely. So they're still around. And the number of tax credits have actually not only they have not been minimized, they've actually expanded over the years. So our final tax credits report will be coming out, and it deals with 2019. So that was the peak year in all the reports we've published so far, with 22 tax credits. So the other issue, exemptions and credits. So the other one is that the main one is the GET exemptions. As we know, general excise tax, it's a quote unquote privilege tax on businesses, privilege of making business in Hawaii. However, in reality, it's actually a form of a consumption tax, but it's different from a sales tax in the sense it's not just on retail goods, but it covers a whole bunch of other activities, including wholesaling, farming, services, renting, business interest income, royalties. And there are differing rates, as we are all aware, who live in Hawaii, that typically it's 4% on most activities, but it's 0.5% on wholesale activities where a business sells goods or services to another business for resale to minimize the tax pyramiding. And on insurance sales, it's 0.15%. What is the use tax? The use tax is trying to impose the same general excise tax on the goods and services and contracting that are imported to Hawaii, so it complements the general excise tax. What is the exemptions? The exemptions are all the taxpayers have to file periodic returns, the G45, and also an annual report at the end of the year. And together with these periodic and annual returns, they're asked to file the so-called Schedule GE, where there's a list currently of 58 different exemptions that would be applied to the gross receipts minus that exemption amount, would lower the amount of the income that would be subject to general excise tax. Now, how is that different? The idea of the general excise tax is that it is imposed on gross receipts. So that can be confusing for businesses, because when they think of income, they think of net income. So they would be deducting costs and, it would be on profits, but this is different. This is on the gross receipts. So in effect, with the use of the exemptions, the tax base again is eroded, with such extensive list especially. And it also creates complexity, a euphemism for administration of the tax, which means that the tax department has to follow through with each and every one of these exemptions. So it does create extra administrative load to the department. Now, there's one thing though, as much as the TRCs have advised for minimizing these exemptions, given the fact that it shrinks the tax base and can be creating, picking certain industries over others. One thing that keeps coming up to the legislature is trying to exempt actually more things, such as healthcare, food, apparel, shelter, from the general excise tax. And the 2005 and 7 Tax Review Commission warned against that, saying that the idea is that this is a tax on consumption. So for instance, exempting just healthcare and clothes at the time, they estimated this would cost about $500 million. What that would mean is that if you want to be revenue neutral, you would have to, with the GET revenue going down by 500 million, you would have to actually increase the rate from 4% to 5.1%. So this is the kind of inefficiency that was being put forth. Now, so the bottom line is that GT exemptions have neither been eliminated nor minimized, apart from a brief period between 2011 and 13, where a number of the exemptions were temporarily suspended. So we have that natural experiment. And when last year with the COVID crisis in full force, and there were again similar bills that came into play to kind of potentially enhance revenue. So this was one of the things that got recycled, that came into play again. More on that after Winston's presentation, and I'm happy to provide more information and more in-depth analysis, having been involved in prepared tax credits reports in the past and have been preparing the GT exemptions report. So we have better data and better understanding of these issues that the previous tax review commissions did not have the luxury of. Now, there are also a few details. The GT exemption on nonprofits. The thing is, while the tax review commissions have considered maybe eliminating the GT exemption on nonprofit organizations, the 95 to 97 tax review commission actually said it should be expanded, at least in terms of medical services, to for-profit institutions as well, as a matter of equity. Whether you get the health services from profit or nonprofit institution shouldn't matter. But they did also point out the potential non-compliance by the nonprofit organizations, and in general wanted clarification for the nonprofit exemptions. Now, why does it matter is that this is actually the second highest GET exemption is for nonprofits. So we calculate the so-called tax expenditures in our GET exemptions report, and our finding was that it costs about $240 million to provide this GET exemption for nonprofits. And the rationale in the past tax review commissions was that, look, GET is a tax on consumption. It's not on profits. So at the end of the day, it's not a nonprofit is not being unduly taxed. It's actually the services that they're providing is being taxed, whether you get it from, whether you go to a private hospital or a nonprofit hospital. who is actually being taxed is that when it gets passed on to are the consumers. So for that reason, they did recommend eliminating the GT exemption on nonprofits, or at least establish a maximum exemption amount, realizing the huge revenue cost impact of this exemption. Now, the final one is the so-called business incentive tax credits. There are several of these, and you know, there was I think Seth made a presentation about talking about tax credits, and he did specify how some are for social welfare purposes, but there are a number of them to kind of encourage certain business activities. So these are the ones that fall under the business tax credits. And a number of the tax review commissions have pointed out that there is need for more accountability of all these incentives. They should go through a legislative process, and they should also be subject to enforcement by either DOE tax or some other agency. And this has been somewhat implemented. Sunset provisions have been put in place for a majority of these business incentives, like the film credit, tax credit for research activities, and some requirements have been put in place in terms of reporting. So the film credit is managed by the film office under DBET. So the other departments have also been involved in certifying these and making sure, doing the due diligence, given the huge burden just administering these tax credits would bring to the Department of Taxation itself. Now, so one answer was, so I saw this in Winston's memo, that he did look into actually the state auditor's reports, which is great. So one piece of legislation was, okay, let's have an outside entity look actually into these tax credits and exemptions. So they're tasked with looking into about 10 of them every year, and this is going to go on for the next 10 years. They've already done 2 of them. And we do provide support to the state auditor's office, but you know, they do their own independent evaluations. They look into what are the costs, the revenue costs of these exemptions and credits, and they're supposed to say something about equity versus efficiency and the economic benefits and what are the costs, and they're supposed to make whether it did reach the goals of the legislature when they had first enacted them. So rather long list of things, and unfortunately some of which are not easy to answer or they're not able to, and if you do look at their report, you will see that what a difficult task that is. And then they're supposed to recommend whether each of these credits and exemptions should be retained as is, amended, or repealed. So it is important to have definitely some accountability and an overview. So this has been taken into account, it seems like, by the legislature. So I'm happy to, as I mentioned, to provide further information when it comes to the tax credits and exemptions. As I said, in terms of data, looking into some of the details, as Winston pointed out, so we can discuss it at that time. The last from second, the taxing the pensions and other retirement income issue. So Winston covered it under exemptions. We had thought as a separate issue in and of itself, but the idea is that several of the past tax review commissions did look into this issue, whether the pension income should be taxed. It's unfair because they're treated differently from defined contribution plans such as 401ks or other similar deferred compensation plans. And the pension plans, the defined benefit plans, which is currently exempt from the state taxation. And one of the things that was pointed out by Professor Andrew Mason, emeritus professor at UH, who is an expert in aging and these matters, he did have a report to the 2001 and 2003 TRC, and he pointed out that in the long run, most people actually are switching over to the deferred compensation plans. So the burden is actually going to be offset due to the population trends. However, based on equity and fairness concerns, the Tax Review Commission of the same period said they should be taxed in the same way. But in order not to create extra burden, this should be having a delayed phase-in, and it should not apply to people who retire before that date, in order not to penalize the current or prospective retirees who might not have time to make that financial plans, or they made their financial plans based on the exemption will be taking place in their current or future retirement benefits. Now, the 2005 and 7 Tax Review Commission also acknowledged the unfair treatment, and they pointed out another equity concern, though, that people did make these employment decisions based on the current tax treatment, and the majority of these pensions, I mean, in the case of Hawaii, are actually the state and county employees. Currently, the Employees Retirement System, the IRS, the biggest benefit provider for the state and county employees, has about 130,000 beneficiaries, including retirees and also the surviving beneficiaries of the retirees who have passed. So the concern is that maybe people have taken these employment jobs, government employment jobs, with the expectation that they have smaller government pensions and it will not be taxed down the line. The other thing that has changed is that for the ERS, there has been some changes. In the past, the employees did not have to contribute towards the retirement plan. Right now, it's about 8%, and prior to 2011, it was, I believe, 6.2%. The contributions are taxed upfront, so that unlike at the federal level, which does not tax contributions to the retirement income, they only tax it when you're actually getting the withdrawals or distributions from either 401k or pension or whichever. They do not tax them, but Hawaii taxes the employee contributions. So in effect, some measure has been put in place where you're front loading the taxation of these retirement benefits, not when they're realized, but at the time that people are contributing to them. So the one difference was 2005 and 2007 Tax Review Commission said, let's exclude a base amount. And then that way, if somebody is receiving a relatively small pension, this wouldn't even affect them. So they would still have the exemption, or you would only be taxed beyond that base amount. So a number that did get thrown around, I think at the time, was about $50,000 they looked into. So let's just say any additional pension income, if somebody's having a really high pension income, they would get taxed on that. But if you have a relatively modest, it won't be. Now, the 2015 and 17 Tax Review Commission was against having a base amount that way, because they realized that it significantly reduces the tax revenue that would be generated if you remove it. And then they also had a huge concern about state meeting its tax adequacy goals. So that would basically make it more difficult. But the one thing that was different, this did not appear in the previous tax review commissions, is that they not only suggested taxing pension income, but they also suggested taxing the Social Security benefits as well. So this was not something that was suggested before. What this means is that in this case, everybody's Social Security benefits are exempt from state of Hawaii taxes. So there's no equity concern in that regard. Anyway, so next week we will be providing some revenue estimates, and I'll be getting more into detail and providing more analysis and how it affects different segments of the population of the residents here in Hawaii. One thing that again, the consultant report was thinking that a base exemption would still be a good idea given the strong political opposition. And they also pointed out that maybe this would be violation of a social compact with the public employees and the government, and in a similar fashion, at people, by accepting these jobs, got into this career path, thinking, this was part of the benefits that they would then have in retirement. And the other concern was that if you only do it on prospective pension filers, right, then this revenue impact will not be coming about for a long time. All right. So finally, this is the issue that Vice Chair Miyashiro will be presenting about, is that both 2010 and 13 and 2015 and 17 tax review commissions did recognize that, yes, the commission is not empowered to make recommendations related to the state expenditures, but there is this serious concern for unfunded and underfunded liabilities that does threaten the functioning of the state regarding the healthcare and pension benefits, and there's no way of getting out of them in the sense without potentially reducing the provision of the services that the state government provides, unless either by raising revenues, increasing taxes, or reducing expenditures. So those are two parts of the equation. Since they do not have the power, they suggested forming a separate commission, a national, which is similar to the National Commission on Fiscal Responsibility and Reform, or the so-called Simpson-Bowles Commission. So the idea was that this commission would have a singular focus. They would provide a drill down study, and they would provide recommendations in terms of not just looking into the revenue budget, but look more closely into these budget shortfalls and what other things can be done in terms of expenditures as well. All right, so this completes my presentation. And with that, I'll stop the sharing. Happy to answer any questions, or
thank you. That was really excellent. It was really a good good baseline for us to work from. And I know that we'll be having more discussion as you collect more information, but does anybody have a question or comment about this today?
I had a bunch on the various topics, but probably too many to do all at once, but just one, just since we were talking about it recently. Are state and county governments moving over to defined benefit plans, or are they sticking with their pensions? Or sorry, defined contribution.
So far, it's still the defined benefit plans. I mean, it is still offered as a possibility. Nobody can stop you from having a 401k, but the state or the county is not matching your contributions.
Yeah, so the statement then that as 401ks become more popular relative to pensions, that we'll work our way over time out of this inequity. That's only true for the private sector employees. It is not true for government. They're sort of getting this ongoing subsidy. Right.
So that was Dr. Mason's report. So the Tax Review Commission didn't agree that to be a big enough of a factor. So they did still go ahead and recommend taxing the pension income. So yeah, again, as I said, I'll provide more details. I mentioned so many things. These are the issues that we had identified. The idea was to kind of look back what has been discussed. As you have noticed that there have been even contradicting recommendations to increase exemptions, decrease exemptions, and you know, I think it was a good exercise, and that what the urgency was that before the very first point that we can possibly do this. So that was the idea. And then from this point on, you know, you will be the ones who are deciding, and I'm here to support, and our office is to support mainly for those informed decisions that you might be making.
Thank you. I do have one question about tax credits and exemptions, particularly for business. And as you noted, tax review commissions in the past have repeatedly recommended eliminating or at least reducing the number, and the opposite has actually happened. You did note that at least several of them now have sunset dates where they are re-examined, but I'm assuming that there really isn't any thing that goes into the creation of these tax credits and exemptions that would specify what they are being created to do. Like there are no outcome measures that are collected. And I'm also concerned about transparency, because even to the extent that there is a review, it's not clear that the public will ever have any idea whether these tax exemptions provided anything except for money to the companies that had them.
You're absolutely right, and the sunset dates keep getting pushed back as well, right? And then I think the state auditor's report does point out that they were not able to identify what the original intention was for most of these exemptions. So it is a concern. I mean, it is definitely, it seems like the language was directly borrowed from the Tax Review Commission for giving the task to the state auditor. But I mean, yeah, I mean, I forgot to say at the very beginning, it was there in an asterisk, but none of the views expressed should be attributed, that I say, to our Office of Tax Research and Planning or State of Hawaii Department of Taxation. So I'm you know, when I express any views, it's completely my own. The state auditor is given a kind of a difficult task, I would like to say. And I'm not sure how much their staff are necessarily trained in economics or can really answer such comprehensive questions, to be honest.
Right. So if there are no other questions, I think this makes a great segue to Winston's memo and report on tax credits and exemptions. So Winston, are you prepared?
Certainly, yeah. If I could just start off, good afternoon, everybody. I just want to give thanks again to Seth, the whole Department of Tax, and everybody there, because a lot of the information, reports, and data that I reviewed were compiled by them. So I found it extremely helpful to have that at my fingertips whenever I needed to pull up a table or a prior commission report. So it was very accessible, and there's a lot of information out there. And I think I found that when I started on this review, it was initially supposed to be a broad sort of review of the tax credits and exemptions in the state, but it just would not be possible to address every single issue that every single taxpayer has. There are just too many specific statutes and too many specific issues to really, evaluate in one report. So I think that with that review in mind, I turned to the auditor's reports, which were formed after the legislature wanted a continuous review of the state tax credits and exemptions, and the commission, sort of pushed that ball to the state auditor saying, okay, well, you have the resources and the mandate to do this now. go forth and do it. We'll put it on your table. And now that they've started doing that, I think that it would be good for the commissions to take those reviews from the auditor. And as Baibar said, maybe they aren't, quite as equipped to grapple with the tax and the economics issues as the Department of Tax, and especially as the Tax Review Commission. I think this is probably the best bridge between those auditors' reports and, the sense of tax policy and the sense of economics and, tax governance in Hawaii. So I think the commission is in a great position to use those reports and, start chipping away at what seems to be a very complex tax credit and exemption system. As indicated by Bybars, there's about 22 credits right now, or at their maximum in 2019. So despite previous suggestions by the commission to simplify the system, it just really hasn't happened, and it's going to take an incremental effort. So that goes to the first suggestion that I had, was that we should use these auditors' reports. I think 2 have been issued within the past year pursuant to Act 177 of Session Laws Hawaii 2017. And there are more recommendations there. However, a lot of those recommendations did involve advice to the Department of Tax and to the administration. Whether the commission's in the best position to provide that sort of advice, and whether that will be, received well or actually like put into plan is, I'm skeptical of that. I think that the commission's always sort of been a liaison to the legislature and how they write laws, and they consult it during their sessions. So I look specifically at the recommendations that the state auditor made in regard to statutes and exact laws and exemptions that were on the record. Just a brief overview. There's only about 2 or 3 per report that I saw that really would fall within, what I thought we could review and do a good job at. The first of those was a clarification of the gross income and gross proceeds of sale under HRS 237-3B. If we do ever want to fall asleep at night, go ahead, pull up the statute. It's a beast. It's been sort of assembled by piecemeal over the years with a lot of semicolons and a lot of different provisions that I think the auditor even acknowledged don't make much sense at this point. So I think an in-depth review of that, and it was a pretty simple suggestion by the auditor that yes, this is undecipherable even by our standards, even for a bunch of auditors sitting at a desk. So I think that for them to say that, we'd be, remiss not to include that in our review of the credits and exemptions. The next suggestion they had was with HRS 237-24.3, number 11. And that was the evaluation of exemptions to support inter-island air carriers. And what was strange about this was that the auditor found the exemption in place applies to interstate air carriers, although it was intended to apply to inter-island air carriers, which is quite a big difference because interstate air carriers go throughout the nation, and the inter-island, air carriers are intrastate, right? INTRA state. And so there's might have been a mix-up at the implementation of this exemption at the legislature or the adoption of it. But I think the auditors also acknowledged that it was a relatively small exemption amount that was claimed by taxpayers, and there were only a few taxpayers relative to other exemptions on the book, so that it was ripe for an examination as well. The next one was HRS 237-24.5, which was the evaluation for the exemption for amounts received by securities exchanges or exchange members. And the auditor observed that there are no securities exchanges in Hawaii. We don't have that type of market here. However, it's still being claimed by a few taxpayers, and which raises questions as to who are these securities exchanges and what type of market do we have here, and why do we have an exemption on record that we're not able to evaluate with the data, and that we don't see the actual market forming here. So I think the auditor was well placed in their assessment of that exemption as well. Moving on to the next report from 2021 in April. The auditor pointed out that there was an exemption for amounts received by blind, deaf, or totally disabled persons from their businesses, but there was also another provision in the General Excise Tax Code that limits GETSS to only a 0.5% assessment. So when that exemption is read along with the 0.5% limit, the exemption is really only worth $10, which if we're talking about simplifying the tax code, that's a easy place to start. This exemption is not really worth too much to anybody these days, especially because the limit was imposed back in 1947 when it was contemplated. So I think that the auditor offers some good advice there, and we'd be, we should, definitely evaluate that exemption as well. The final observation that I saw was in HRS 237-24, which was the exemption for sugarcane farmers and sugarcane producers in Hawaii. I think it was well publicized that in 2016, Hawaii's last sugar mill shut down. It's no longer the industry it quite was. And I think while it's still being utilized and while it's still being claimed by taxpayers, I don't think that it quite has the extent or the benefit that it was contemplated back when it was adopted. And the auditor pointed this out as well in their reports. While there were other recommendations that addressed tax credits and exemptions, namely the adoption of metrics by the legislature and how they should start to adopt tax credits and how they should evaluate them down the line, I think it'd be really hard to really put those into a legislative suggestion for the commission. It'd be hard to suggest that at this point. Sure, we can, encourage the legislature to continue being transparent and try to encourage evaluation of exemptions after they get put in place. But at this point, I think the commission is best served by evaluating the current system in place and whittling down those exemptions that aren't really carrying out their original purpose. After that, after looking at exemptions, I looked at the credit system in Hawaii, and there wasn't a real comprehensive report on that by the auditors done. So I kind of leaned into some cases that I've been familiar with the capital goods excise tax credit. And this is an example of just a statute that is, it's written in a way that's confusing, to say the least. Whether or not, the department's interpreting well or not isn't really their fault. They were left with a credit that allows you to claim it on two different types of cost or basis values, but the definition really limits taxpayers to only one of those definitions. So if we're talking about simplifying the tax code, I think that the capital goods excise tax credit, which is really in place to, prevent the double taxation or pyramiding of the GET, not to give a benefit to particular taxpayers. We should think about cleaning that up and resolving this issue and making sure that it's clear both for the department and taxpayers going forward. Moving on from the GET, I did note that the exemption of pensions and Social Security benefits was a topic, and I think BIBAR has really hit this on the nail with the past, I think 4 commission reports. They really, discussed this at length, and it really started with the 2001-2003 commission and that report by Professor Mason, which discussed, the aging of the population, what type of effects this would have. And I think that in Seth's presentation to the commission, it was really apparent that pension and Social Security income constitute the largest source of untaxed income for the state. And I think it comes out to about $5.7 billion. And the slideshow that we reviewed, it also accounts for about 16% of individual income, which is larger than individual income from capital gains, self-employment income, and interest and dividends put together. So whether or not the state wants to keep this exemption in place, I think is, something that the legislature ultimately has to deal with. But we should give them the amount of data necessary to evaluate the cost of the exemption and to see if the trend that Professor Mason anticipated in 2003 was really, has it continued to this day? Have 401ks really phased out on the pension plans contemplated at that time? If that hasn't happened and we do have an aging population, then there is, I suspect that it could be a larger portion of untaxed income going forward, and that if the state is going to balance its budget and look at sources of revenue, then it has to look at the largest exemption that it's granting on the income tax side. Finally, when I was combing through the Department of Tax's reports on both the credits and exemptions, I found them to be extremely helpful. And I think that the data that they provided, especially on their data portals online, was really something that the department should be proud of, because it really points out how many people are claiming the taxes, how are the tax credits and exemptions, what amounts are being claimed, and how much it's costing the state. And that was all something that the legislature really enjoyed, that originated from the 2007 report issued by the commission. When the Senate Committee Resolution 58 came out, the legislature was clear that having this data available alongside the commission's report was something that it found immensely helpful. So I think that, you know, taking that into account, we would be remiss not to include our best evaluation of costs and revenues for credits and exemptions going forward, even if it's not quite as in-depth as the studies that were published within the past year. I think just having those tables and that data available, the legislators can turn to that. They can use the Tax Review Commission report as sort of, you know, a cheat sheet going into their legislative briefings, into their sessions. That way they know exactly how much these credits and exemptions are costing us, who's claiming them, and how many times they're being claimed over the years. I think I was hopeful hearing Bybar speak earlier that he's been doing this for some time now with Seth, and that they've you know, dealt with the modernization of the tax system and the data that's available. So I'm hopeful that this can all be done at an efficient cost. You know, that the department's been through this show before, they know how to put together these reports, and that it would be a, you know, efficient way for the commission to spend resources, because the legislature has clearly indicated that it's something that they like to see with the commission's reports. And if, you know, we're familiar enough with putting this product out, then if it can be done, I think it should. So given that the data only goes to 2019 for exemptions and 2018 for the credits, I think just giving updates with the most recent data available, if that includes 2019 for both credits and exemptions, or possibly some 2020 figures, I think that would be immensely helpful to the legislature going forward. Having gone through the specific points, I think just the overview of the tax credits and exemptions is important to note that there has been a criticism from legislators during my interview for the Tax Review Commission, and just speaking with them in the halls, that, you know, these are seen by the public as sort of handouts to lobbyists and special interests, and those who can afford to lobby for an credit and exemption are the ones who are actually going to benefit from them. So I think that, you know, even though it's kind of sludging through some really, you know, minute details and some small statutes, I think that cleaning this up goes a lot to show that the state is being accountable with how it evaluates its tax credits and exemptions going forward. I think we can all acknowledge that it's not a simple system to analyze right now, and I've done my best to try and distill it down to a few issues that we can, you know, just address in our own commission's report, and hopefully set up a framework for future commissions that they can work hand in hand with the auditors who are mandated to review these credits, and that, you know, we can use our expertise and our community connections to, you know, look over what the auditor's given us and then approach the legislature with some real-time solutions going forward. With that all said, I don't think there's any more that I can talk about at this point. So if you've got any questions, feel free, fire away.
Thank you. That was great, Winston. Appreciate your work. Questions?
Can I just say that, I mean, I intended to, I'm more than happy to provide all that information that you suggest, actually, in the large appendix report. Okay. And then I would be making a presentation, because as you said, it's so extensive, and it's easy to get lost in details. So what are the important aspects, and what are we talking about? What are the costs? What are the benefits? To the extent that it's possible, you know, I'm more than happy to provide that as part of the report. So that was my intention. That's what I meant by envisioning it something larger than was in just the scope that was indicated. I'd be more than happy to incorporate them.
Great.
Great, thank you.
Other questions or comments? I've got maybe a couple of things. One of them is you were talking about a few instances that were highlighted where the language was so murky that nobody knew exactly what it was supposed to mean. Are you suggesting that one of the things that we can do to help is to rewrite the language in one or maybe several ways to give the legislature options depending on what they actually intended with the original legislation, but just make it clear what it would do in the legislative language.
Certainly. I think the easiest thing for us would just be to, echo the auditor and just put a rubber stamp on it and say, we saw this, you should look at it again. But no, I think it would help to be proactive in that way and to, put out some suggestions. And if, the commission members are able to agree that, this would be based on our perspective and our evaluation of tax policy, efficiency, equity, this would, be most in line with what we're trying to affect and what the original purpose of those statutes were.
Yeah, I think that it would help if we actually gave some examples, because maybe they have not provided clarifying language because they don't know how to clarify. Maybe they didn't understand the original intent.
Sure. I think one of the big concerns from the auditor was, and I think Bybar's noted this too, was that in a lot of the longstanding exemptions and credits, there is no evidence of the legislative intent. These were adopted some time ago, and it's not clear from the statute what they are trying to achieve. So even putting that into print for, revamping a longstanding creditor exemption, I think would be helpful.
Yeah. Another thing, as you were talking about pension exemptions, and I thought of this also when Bybars was talking about this, much of the concern is about state and county workers who get who get public pensions and they don't have to pay taxes on it. But there is also a number of people who get federal or other kinds of pensions, mostly federal, I suspect, or military pensions. And as I recall, don't we also exempt Social Security income? So even if public worker pensions in Hawaii are problematic, there may be some way to recoup some of the revenue by taxing other pensions, but I don't know whether that would bring up an equity issue.
Right. I think some of the prior commission reports, I can't remember which ones, said they didn't disagree with the idea of giving a tax break to those who are on pension and fixed income going forward, because that was a concern that's raised in every single one of those reports. I think most of them conceded that while it's an admirable aim, there might be easier ways to achieve that, sort of tax relief for those people in a simpler way, which would include, maybe a higher age personal exemption that is claimed by retirees and those who have reached that age. Also, I think there was a concern that I think the equity being the overall concern in 2001 and 2003 drove the commission's report at that time, but also the aging population at the time of the budgetary concerns, I think can't be understated as well. But if I think that just the proportion of income when it's put onto a pie chart like it was with Seth's presentation, I think that giving a broader relief to people on fixed income or retirees as a whole could be achieved through other means. I mean, that's certainly possible, and I didn't go too deep into finding alternatives because I think it's been pretty contentious, and I think the commission deserves to talk about it. But I think just evaluating the revenue costs of the exemption just because of its magnitude are important, the most important thing.
Yes, thank you. Anything else? Okay, then I am going to go on to the next item on our agenda, where I'm going to be talking about real property taxes, and I'm going to attempt to share my screen. So let's see what happens when I do that. Okay, am I in slideshow mode? Okay, good,
Yes.
thank you. So I just wanted to note that going back to the first Tax Review Commission's report in 1984, they talked about the unusual situation where there's a disproportionate amount of responsibility and public activity at the state level here in Hawaii as compared to local or county governments. They also made a point of saying that after 1978, when the CON provided the authority for property taxes to the counties, that the property tax rates declined, although they also note that revenues didn't necessarily decline that much because of the increase in the value of properties. But that provides the context for talking about how we are going to meet a growing array of public obligations. And this is a short list that I came up with from various sources. And I'm sure we could quibble over the amounts and what's included here, but I think we will all agree that we have some very significant capital costs ahead of us, including climate change mitigation. If we want to address our housing crisis, we need to put a lot more money into housing. And then the biggest oversight for our public education system, which is unusually, in fact, uniquely, a system at the state level and not shared by counties, is providing public preschool for our 3- and 4-year-olds. And that is not a capital cost, but it is certainly an ongoing expense for the operating budget. And looking at the operating budget, it is not all that clear how we would be able to accommodate all of these costs. This is the fiscal year 2022 operating budget for the executive level at the state. We're spending almost $16 billion, and just education, Medicaid and social assistance, debt service, and public worker pension and OPEB alone take up 48% of the operating budget. So it is problematic to think about how we would be adding a lot more costs for things that I think arguably we would all agree need to be done. Part of the problem also is if we are looking to the state to have responsibility for doing this, we have to come up with revenues. And I think the potential for revenue raising under our current system is rather limited. The biggest source of revenue for us, of course, is the general excise tax, but because it's so broadly applied, even though the rate is relatively low, it constitutes a heavy burden for low-income households. The second largest revenue source is our income tax, and we were just talking about the issue with seniors. So we know that the demographics are more people who are aging out of the workforce, retiring, getting more and more exemptions, not having more income in terms of taxable wages. But my data is out of date. So I talked about $4.6 billion in retirement income that was exempted, and Winston talked about 5.7, and I'm sure it's even more now. But another problem that we have in our income tax system, and our income tax system is a progressive system that works the way I think we want an income tax system to work, but our economy tends to produce low-wage workers. And so 56% of filers had an adjusted gross income of less than $50,000. And of course, they don't pay much in income taxes. So you have the majority of the filers paying a pretty small portion of the the taxes. And meanwhile, with our progressive income tax, the marginal rate is probably not going to produce all that much extra income because we have a very small number of people who earn a lot of money. So those are a couple of problems that we would have. So that brings up why I think we need to be looking to the counties to pick up more of the responsibility for people who live here, and looking at real property taxes as a means to try to make up for the revenue needs that we have. So Hawaii has the lowest average residential real property rate in the country. I think everybody is aware of that. Because our property values are high, we come in 20th in revenue that is raised by these property tax rates. But you can see here how our rates compare to the national average, and also how much the average homeowner in Hawaii is paying for the median value home compared to the national average. So the 1984 Tax Review Commission report talked about how the counties would have raised $16.5 million more if they had not reduced their tax rates. So I've kind of brought that comparison up to date. I compared 1983 rates to current rates. And it looks to me like there is a fair amount of potential revenue that could be raised by the counties, particularly for Honolulu. So Honolulu would be able to raise potentially another $556 million if it had increased its property tax rates. And this is for all kinds of property, not just residential, and so forth. Maui already has increased its property tax rates to above the rates that were in effect in 1983. But overall, if you add all of the counties together, there would be a pretty significant amount of money that could be raised. Now, talking about housing, Hawaii has always had a housing crisis, or at least in pretty much anybody's living memory. I think the housing crisis was being described back in pre-World War II days, and it is related to the scarcity of housing and the cost for building housing. But we also know that in recent years, a lot more of our residential real estate has been bought up by investors and people who are looking for vacation homes. And Hawaii is a great target for those markets. The value of our housing keeps going up. It's a very attractive locale, particularly for people who are looking for vacation homes. And because our real property tax rates are relatively low, certainly lower than a lot of other jurisdictions, then it also makes it a reasonably inexpensive investment for people on an annual basis. They're just not paying quite so much. So the counties have already started addressing the issues of the housing market through the real property tax rates. So until about 1995, all of the counties had a single improved property or improved residential property tax category. So they had different rates, but they only had one category. But that's really diverged since that time. So now all the counties have more advantageous rates for homeowners who occupy their houses, so homesteads, owner-occupied properties. And there have been a variety of strategies that have been used to increase taxes for commercial, investor, short-term vacation rentals, all of the other kinds of things. And the newest innovation in property taxes that I've seen is that the rates are being increased for higher value homes. So above $1.5 million on Maui, I believe, and above $2 million on the Big Island. So as I see it, real property tax rates are an opportunity for us. We can increase the property tax rates on residential property that is not owner occupied, and that money can be used to pay for a lot of other needs that we have, particularly capital, and the increased revenues can be used to finance bonds to subsidize the capital. And there are some examples of some places where they have done this successfully, including Los Angeles, San Francisco, and Portland. And I know that there was a proposal before the Maui County Council, and it sounds like that's not going anywhere immediately. But there are some solutions that can be put together using increased revenue from real property taxes. So with that said, the recommendation that I would make to my fellow commissioners is that we should encourage the counties to explore ways that real property taxes can enhance the revenues to support housing and other growing capital needs. So that's it. Let me see if I can stop sharing here. Back to you. Any questions or comments?
As a state, I think you may have brought this up yourself before, Beth, but as a state tax review commission, can we even make recommendations to the counties about their tax situation?
I think that we can make recommendations. And in fact, the 1984 Tax Review Commission did address property tax rates. And if I'm not mistaken, there was commentary before. So it isn't as clear cut. It's not like the legislature can do anything about that recommendation. But I am hoping that the counties also would be interested in taking a look at any recommendations that we make that affect them.
And then just a follow-up question. This is maybe a little more technical, so I don't know if this is for you, Beth, or for Bayvars, or for Seth, but I know there's differences in tax rates for owner-occupied versus not owner-occupied. Is there any difference? So in the non-owner-occupied world, is there any difference between resident owners and non-resident owners, or is it just all based on whether it's owner-occupied or not? Do you understand what I'm asking?
So there are different rates for residential properties. The best rate goes to a residential property that is occupied by the owner. So they might call it owner occupied, it might be called homestead, but those enjoy the most favorable rates. There are other residential categories that are not necessarily occupied by the owner, and they have a higher rate.
And I think what
Oh, go ahead.
I was going to say, I think what Murray may be asking, which is what a lot of people are bringing up now, is can we differentiate further between non-Hawaii residents, non-occupant, and Hawaii residents? And that's my understanding is that's not constitutional. We can't make that differentiation. So that's why.
Yeah.
So we make the differentiation based on other than Hawaii residency status.
Yeah, thank you for clarifying. That's absolutely right. That in the memo that I put together, I did include the example from Vancouver, Canada, where they can do that, but we can't. So our discrimination is based on utilization. You know, what's the property being used for?
I thought it was excellent. The presentation was excellent, but I thought the memo was also really well done. And the opportunity, I think, to tax wealth as opposed to income, I just think is a real opportunity that we'll get to some of our non-resident owners to help increase that. So, I mean, even if we aren't necessarily supposed to opine to the counties, why not, right? I mean, I don't know.
All they can do is dock our pay.
Exactly, right? I don't know, Seth,
Just-
do you think they would, how do you think what do you think the reaction would be towards with a recommendation coming from us to the county? So we're just saying, consider this, right?
Sorry, Seth,
Winston?
I'm gonna jump in for a sec. There's actually a Oahu Real Property Tax Advisory Commission convening right now at this time. Not at this time because I'm on it right now. I'm serving in it. So the report's supposed to be issued by the end of this, I think, the end of this year. But they are discussing a lot of the points that Beth brought up in her memo and her presentation that I thought were very informative. Among these, just a few points that I like to just sprinkle in my observations, at least. I do know that Maui has enacted its newest classification system right now. It's considered that short-term rental classification, and it treats any property within a zoning area that allows transient vacation use, which basically encompasses the entire south side of the island, mostly Kihei, all of that development, that if TVU use is permitted there, then if it's a second home, if it's not your personal home or residence, then it's automatically classified as a short-term rental. And if you can look at the table that Beth provided, those rates are significantly higher than they are for the typical residential rates that you would find in Maui. They just adopted this now. And one of the issues that the real property assessors, at least in Honolulu, have contemplated with a classification like this is that it goes against the typical taxation of property, which classifies property at its highest and best use. And that looks at a property and says, okay, what's the best possible thing you can do with this property? That's what we're going to value and appraise your property at. That's what your basis for tax is going to be. The difference between these classifications is, especially when you get to a short-term rental or something like that, or a vacant property, which is being contemplated too at the time, is that it looks at the actual use of the property. And the issue there becomes, how do you enforce the actual use? How do you determine that? Because say a property owner is there for 6 months and 1 day, does that constitute long-term use or occupying it as a residence? What happens if they rent it out to a lessee? What happens if they rent it out to a couple of lessees, but they don't have a lease on hand? I mean, it really becomes a matter of enforcement for the assessors and the counties at that point. So I know that that's been the main concern for these taxes going forward. Everybody's kind of waiting with open eyes and ears to see how they're doing in Maui County with the assessors there, and to see how they're treating this new sort of classification based on use, because it does sort of it sort of veers off from the typical highest and best use classification that's standardly the standard and the accepted way of running these tax systems. So it's really interesting to see this, and I think that the county and the Oahu Real Property Tax Commission is this is probably the biggest issue that we're facing right now in our meetings. So I think even if the Tax Review Commission, this commission, were to offer advice, I think the Real Property Tax Commission, at least in Honolulu, would be receptive to that.
Thank you.
Maybe just one last follow-up question from me on the interplay between county property taxes and state. What was it, HARPTA bars that you mentioned, that's a state withholding when they sell a property, was that right?
Yes, but it's not on real property tax. It's about that the Hawaii individual income taxes that they would be liable to because they made some money in Hawaii from they had some capital gains realizations by selling property. Yeah, right. So it's basically individual income tax, and then that would necessitate them to file an income return so that they can get a refund from some of that withholding if they actually, their tax liability should be less than what was withheld. The only thing I mentioned was the state cannot tax, but one thing that the consultants had looked at was there is a deduction, an itemized deduction at the federal and also at the state level for property taxes paid. So the consultant report was saying, well, maybe, you know, you can remove that exemption. So that could be one way to kind of include an extra burden for owning property in a way.
Yeah, it's sort of
That
an
was the only
indirect
one.
way of- It's an indirect way of having a state property tax without having a
Exactly.
state property tax in effect.
Right.
Yeah. But just sorry, last question on the HARPTA. You said that when they dropped it to 5%, it wasn't clear that they were going to sort of recover all the monies they were owed for capital gains or maybe excise taxes on rentals or whatever it was. And then they raised it to 7.25 or whatever you said it was. Are we confident that that amount is capturing all that money, or do we still think there's a need to go back to the 9% to capture, you know, unpaid capital gains or unpaid excise on rental income or whatever else?
I mean, we cannot be 100% sure, but it's also clear that that is assessed on the price, on the sale price. So 7.25 on the sale price. So there will be some costs, and it will only be on the capital gains that are realized. And it would only be an issue if this property was belonging to, you know, let's say you had an inheritance. You might actually be, you know, a person from here and had grandparents who passed, and you inherited some property, and then it's such a long time that there might have been a really huge increase of capital gains, but still you would be deducting the closing costs from that. It wouldn't, I mean, we have that issue of if somebody have not paid their TAT or GET overall, like that's a problem. But this withholding, I think, from what I can see, should normally be sufficient to recover and encourage someone to file their taxes, because it's in their best interest to file taxes.
So is
Right,
that,
just can I follow up on the HARPTA one because it's a little confusing?
Yeah.
That's it's a compliance measure, right? I mean, people already owe these taxes no matter what, and so this is just a way of like having the state keeping the money, and then you have to demonstrate you can get the money back. You can submit a form and it takes 3 or 4 months, and the state will approve it. We will approve it, or you can do it on your individual income taxes only for non-residents, right? Because we believe that if you're a resident, you're going to pay your individual income tax anyway. So the revenue implications are actually really small, because like that's only assuming, and we've done research into it, and there's there's not a lot of evidence to suggest that a lot of people are getting away with not paying their taxes.
I do have a couple of other questions about HARPTA. Is the rate, the 7.25, is it applied to the capital gains or to the entire sales price?
The price.
Okay.
Yeah.
And you can understand why this is kind of controversial, right? Because you can, if you're selling a house and you're trying to buy another house somewhere else, and somebody takes 7% of the total value of your house, which is more than your capital gains, it really delays you can't buy another house for a while or do different things. So you know, from a compliance perspective, it always seems really good. But from if you were you know, just selling a house because you were doing it, not having, you know, up to 10% of the price of the house for almost a year, you know, you can get that back early, can be hard, right?
Yeah. And how does the state get the money? Is it collected by the realtors?
Mm-hmm.
Okay, thank you. Okay, we covered a lot of ground today. We are meeting again next week. And at that time, we are going to hear from Alton about Simpson Bowles. We're, I hope, going to hear more detail on proposals for green fee. And then we have more details that BIBARS is going to share with us as well. Anything else we need to make sure goes on to the agenda?
Just a process question. When are we going to decide, of these things? So we've had, what, 3 reports today, right, alone. So when are we going to decide of these things, what portion or entirety of these proposals are we going to actually move forward with as a TRC? When do we debate that?
Yeah, that is a really good point, because we have been meeting and absorbing all of this information. We've got to have some discussion and decide what our recommendations are. So let's plan on starting that conversation next week and devoting our first meeting in October entirely to that, as well as other updates.
May I just suggest that hopefully when I present in-depth analysis, that would help with some of the making more concrete suggestions or recommendations or different policy exercises that the commission might be looking at. So that's why I want to do as many of them as possible, as soon as possible, so that discussion starts. So I proposed the standard deductions and personal exemptions, the taxing of pensions, and the green fee for next week. And then I can do one on carbon tax, and then also later tax credits, and one on GT exemptions. So, but those are way more longer. So maybe let's start with ones that there are things that you might already have recommendations, and which you did have some, based on the memos that were provided. But all commission members would have a say, and be able to discuss hopefully better once I present the data.
Okay, that does sound like a good approach. And as far as the carbon tax, we are still waiting to hear back on that by early November. So I don't know how much work you need to do on that, other than to capture our recommendations and help us to understand anything that maybe we otherwise don't.
I thought that, we don't, rather than waiting for whatever the report might be presenting, so that I could give some background into some of the way it was proposed to be implemented and what it would entail. So it won't be a long presentation. It's just so that we don't have to wait until a report, and I don't know how much time will be left to absorb and translate.
And just something to think about to all the commissioners is, like, what would it take for you not to recommend a carbon tax? Or what it would take, like, what additional information do you, like, I know is the fact that it's going to have distributional impacts on the neighbor islands, is that going to keep you from recommending, or is that just going to be an amendment saying you need to look at that? Like, I would really encourage you, because, like, you're getting the fire hose here, right? So really start thinking about why you care about certain information at all, right? Like, because then that will, like, help you evaluate and think about your recommendations, and also the assumptions that you need to make, and it might help you identify what you really need to know before you move forward, right? Because one of the dangers in learning so much is you're putting off the decision making, but if you kind of like front load the decision making a little bit, or bring it up, it'll clarify your thinking a little bit, and so you can ask more important questions in the next month or so. That's just my recommendation.
That's good advice. I am assuming that unless anybody has strong objections, that the things that we have on our list will be recommended in some form or another. Okay. Okay. Any other business for today? Seeing none, I will see you all again next week at the same time. And the meeting is now adjourned. Thank you.
Thank you.
Bye.
Thank you.
Thank you.